Are you considering whether your business should be structured as an LLC or a C corporation? Confused about the differences between the two? Don't worry, you're not alone. In this video, I'm going to help you understand the key differences between these business structures, their tax implications, and which one might be the best option for your business. Let's start by understanding what an LLC or limited liability company is. An LLC combines the simplicity and flexibility of a partnership with the limited liability protection of a corporation. This means that the owners, also known as members, are not personally responsible for the company's debts or legal liabilities. In other words, your personal assets are protected in case the business faces financial trouble. In addition to this, LLCs have a pass-through tax structure, meaning the income or losses from the business pass directly to the owner's personal income tax return. This often makes them appealing to small business owners who want simplicity and protection. Now, as far as pass-through taxation, LLCs are taxed as part of the owner's personal income, avoiding double taxation. LLCs offer flexible management structures and profit distribution. You also have limited liability protection. Members' personal assets are always protected. Now let's talk about C corporations. A C corporation or C Corp is a legal entity that is completely separate from its owner. This structure is ideal for businesses that plan to raise a lot of capital, as C Corps can issue multiple classes of stock and have an unlimited number of shareholders, including international ones. C Corps also have what's called perpetual existence, which means the business continues to exist even if shareholders change, making it a great option for companies planning long-term growth or public offerings. All shareholders and owners are completely protected from personal liability. Now, as far as perpetual existence, the company continues even if shareholders change. C Corp can also raise capital through selling stocks to investors. The formal structure often increases credibility with investors as well. Now that you know what an LLC and a C Corp are, let's dive into their key differences. First, taxation. With an LLC, pass-through taxation, owners pay taxes on personal returns. With a C Corp, double taxation. Corporation pays taxes on income and shareholders pay taxes on dividends. Now for the ownership structure. With an LLC, can't issue stock, more difficult to raise capital. With a C Corp, can issue multiple classes of stock, unlimited shareholders. Now, what about management structure? With an LLC, flexible management structure. Can be member managed or manager managed. A C Corp is defined management structure with a board of directors and officers. When it comes to paperwork and compliance, with the LLC, less paperwork and fewer formal requirements. With a C Corp, more paperwork, including annual meetings, minutes, and strict compliance. One of the biggest differences between the two is taxation. LLCs are taxed through pass-through taxation, meaning the company itself doesn't pay taxes, only the owners do on their personal tax returns. On the other hand, C Corp are subject to double taxation, once on corporate income and again on dividends to shareholders. LLCs have their own set of advantages and disadvantages. So let's break them down, starting with the pros. They're simpler to set up and maintain. You got flexible management and profit distribution. You got limited liability protection. As far as the cons, it's harder to raise capital and owners may have to pay self-employment tax on all profits. Now let's take a look at the pros and cons of a C corporation. Pros: it's easier to raise capital through stock sales, limited liability protection, perpetual existence, and more credibility. As far as the cons, you're subject to double taxation and more paperwork and formalities to comply with. At this point, you're probably wondering, which one should I choose for my business? So let's start with size and growth plans. With an LLC, it's better for small businesses with fewer owners. With a C Corp, it's ideal for businesses seeking investors or going public. Now, when it comes to tax preferences, the LLC has a simpler tax structure with pass-through taxation, and the C Corp is subject to double taxation, but allows for tax-deductible benefit. Then there's flexibility versus structure. LLCs are more flexible with fewer compliance requirements, and C Corps require more structure but may attract more investors. Ultimately, if you want flexibility and simplicity, an LLC may be the better choice. But if you're aiming for long-term growth, raising capital, and possibly going public, a C Corp might be more beneficial. I appreciate everybody watching. Hopefully this guide has helped you understand the key differences between an LLC and a C corporation. If you found this video helpful, make sure to give it a thumbs up and subscribe for more content on business structures, tax tips, and financial advice for entrepreneurs. Let me know in the comments which business structure you're considering for your venture.